Welcome to the Investors Podcast. I'm your host, Trey Lockerbie, and today we are honored to have on the show Mr. Jim Cullen. Welcome to the show, Jim.
Thank you very much, Trey. Thank you.
I'm very excited to have you on the show. You've written this great new book. It's called The Case for Long-Term Value Investing. And if anyone could write this book, it would be you. You've been at this quite a while, and you know a thing or two, I would say, about value investing. First thing I loved about the book is that it kicks off with this concise history of the stock market dating back to the 1920s. And, right. You know, we study folks like Ray Dalio, who's been on the show, and he says that today's market most resembles the 1930s, but with inflation now climbing higher, some wonder if it's more like the 1970s. If Right. It's the latter, it's important to note how volatile the market was and how it resulted in a flat return from 64 to 82. I'm just curious, what time frame does today's market most remind you of?
Well, let me answer that sort of directly the way we started, our book with background. And, I was on the aircraft carrier 1961 to 64. Market was going up every year. Looked like it was going to be fun, easy. And I got out in 65, went to Merrill Lynch. Merrill Lynch was opening offices all over the country, as was everyone, and the markets were booming, and we had mobs of people every day in our office over there, and it got so bad and so crowded every day that we had to put a plexiglass up to separate the brokers and the crowds, and people were cheering for stocks and it was mayhem, and so it was great. I said, this is lucky, and so that's, the speculation was high. Two big things in the speculation. They had something called the pink sheets, which were this on a clipboard, elaborate, maybe 2-inch thick ream of papers colored pink, which had all the over-the-counter stocks. And brokers were fighting all day to pick stocks out of that and repeat, prices to their clients, what have you. And also those, a character, and I mentioned in the book, called Charlie Plum. We called him Two-A-Day Charlie. And what he would do is come out with 2 new issues every single day. And all the investors were strictly clamoring for him. And so it was similar to some of the things we see today. And actually what happened, linking to the 30s, which Ray Dalio mentioned the 30s, what Merrill Lynch did, they had 3 older experienced vets, brokers in our office to give some stability. And these older guys were, buying, names from the 30s, and they had nicknames for the stocks, Betsy and old, Steel and all the nicknames. And they all were dividend stocks. And we used to say, well, these guys, they're all alike. They all wear red suspenders and smoking cigars. And we said, it must have something to do with dividends. What are dividends anyway? And but we were millennials, most of us there, and we were interested in the hot moving, fast growing stocks. Airlines were big, Pan American, TWA. World travel is going to expand dramatically. We had color television stocks were hot, and so anyway, we had all these new stocks. Industry was formed called conglomerates, where they were highly leveraged companies, or built on debt, and they were just buying up all the kinds of companies around, and they were the most active stocks every day. So it was really a real casino. And I tell in the book, I said, it's like a British betting parlor. I mean, it was mobbed every day. Then all of a sudden, 1968, the market rolled over. And the market, the next 7 years, had 2 major stock market recessions. And by the end of the market, 1975, by the end of 1975, all those brokerage firms were shut down. Most of them were gone, and most of the brokers were gone, and many of the firms that were also involved were also gone. And so that was sort of the initiation of that period, the era of the 70s, which was really much worse than the tech bubble. And of course, the 30s was even worse than that in a way. But so I would say, you wouldn't want a similar kind of experience. But there were 2 shocking things that came out of that. One, later on, not then, but later on, I went back and checked. what happened between 1965 and 1982 when the market was flat and didn't go through 1,000 for that 17-year period of time. And what happened is actually the cheapest stocks on a PE basis, the bottom 20% of stocks on a PE basis actually went up 1,000% over that same time period, which is pretty much the same as they went after the bull market between 1982 and 2000. And that I found that was shocking after having been through it. And because the market during that period was going between 700 and 1,000 back and forth, and it just couldn't break through 1,000. But the problem was the market had been overpriced. And that's always the Achilles heel of all these speculative bubbles, similar. And well, the other thing that happened, and we mentioned this in the book, every single the 1930s, 1970s, 2000, and every bubble period, it takes 5 to 10 years before those stocks basically correct enough. And even though in every single case, the fundamentals for all those stocks were good all the way through the next 10-year period, but all of them were 10 years later were down. I remember in 1982, we bought IBM and Avon products under 10 times earnings with a big yield, and they had been, 10 years before they were at 60 times earnings and 50 times earnings. And the same way with RCA, and then in the same way we had here in the tech bubble, Microsoft and some of the other big tech stocks, we wound up buying as value stocks back in 10 years after the market top in 2000, 10 or 12 years later. I mean, we bought Microsoft, it was like 10 times earnings with a 3.5%, 4% dividend yield. So that's been the common thread in these past markets. I mean, what we have now is a sort of period of, looks like you're going to have a hard time avoiding stagflation, I would think. Interest rates are going up. A lot of factors are going to, I think, put a lid on the market growth. So you may go through a period of stagflation. So our answer probably to that would be the answer, which was back in the 70s. If you bought the cheapest stocks on a PE basis, that's going to bail you out in the long run anyway, no matter what happens. And so I think it's irrelevant which one we're most similar to. They all follow each other, are similar, and all a bit different. And it's hard to believe that some stocks like Amazon, it's going to take 10 years for it to base out. No, but I remember 4 or 5 years ago, Barry Diller, who's probably as savvy as anybody, was talking about Amazon. Was talking about Netflix. And he said, they have such a lead on everybody else. He said that stock is never going to have a problem. Well, 3 or 4 years later, that's not the case. And so that's, so as I said, by the end of 75, my experience was that everything had been wiped. People have been wiped out. Margin accounts are gone. And that's, we hope that we don't get that experience here, but we do have I think the stagflation risk, which means that as far as an investor goes, you want to be careful, I think, because you don't know how these things play out.
On that note, I'm curious with the 60s and 70s, with the last time we had stagflation, the market volatility seemed to just be insane. So while everyone's sitting here trying to say what's going to happen next, interest rates are going up, the stock market's just going to go down, almost like it's binary, but it seemed to just bounce up and down in this range pretty violently. Do you remember that?
Oh, yeah. I mean, every time you thought the market was going down, it was going to go lower. And then you said, this time it's going to go through 1,000. And it didn't do it for, 15 years. So whether you trade like that here or not, it's hard to say, but that's the volatility is extreme. We did a chapter in our book on the bull markets, bear markets, bull markets, and recessions, and how, and going back over the last 60 years, analyzing every recession and bear market, and how that played. Because you say as an investor, you say, if I could time that right, and I can avoid, and that's what you hear the commentary on TV every day is people trying to figure out, we're going to have a recession or we're going to have a bear market, what have you. To our feeling, it doesn't make any difference. But if you look at, what what happens with the bear markets is that first you get the bear market, then usually the recession comes later. You don't know the recession's there because it takes the government a couple months, 6 months maybe, to figure out where it is, and then you get what looks like a really bounce off the bottom. Studies done have shown that if you took over that 60-year period of time, if you took the bounce off the bottom and all those recessionary periods and took that out of the market, you basically wipe out the advantage of owning equities over that entire time period, which is extraordinary. So the key thing is, and he said, well, if I get out, I've got to get back in. So you're probably better off not to get out. And the bottoms look like it was, if you look at the long chart, looks like that would be easy to sort of figure out where the bottom is. But then if you expand that out, some of those bottoms took a year. I mean, we think of a bottom being made and all of a sudden the market turns around. These things could drag out 6 months to a year. And so that's what you don't know where you're at. So if you're trying to take a shorter term trading positions on the markets, it's a tough game. And so that's why it gets to our investment strategy to get around that. It's, buy cheap stocks, and especially if in a tough market like this, cheap stocks with dividends, and stay invested and don't try to time it. And that's the big, that's what we get around to is the message we're talking about here.
So what you just said a minute ago stood out to me. You said basically to you, this volatility doesn't matter. And that's because you're holding for the long term. And in the book, you lay out this very rigid, disciplined approach, essentially using the framework based on Ben Graham, which is as follows. So look for companies in the bottom 20% of the index when ranked by price to earnings. Look for companies in the bottom 20% of the index when ranked by price to book. Look for companies in the top 20% of the index when ranked by dividend yield, and then invest for the long term. So my first question is, can investing really be this simple? And second, how do you keep faith in your system knowing that things change and evolve over time? So for example, price to book becoming less relevant for non-cyclical stocks, that kind of thing.
Yeah, well, they're the three disciplines Graham mentioned, and we get the number every year for the S&P 500. The shocking thing to me is we don't use price to book much at all. I mean, we look at it on all the companies, and it's appropriate for very cyclical, material companies, but for most companies, healthcare companies, what have you, is immaterial. But the performance of that on a historic basis, even recently, has been pretty good, which is surprising to me. I wouldn't think it would be the case. What we do in most of ours, we start off strictly with a value strategy, number one, and then we usually want to take less risk. So we found by adding the dividend portion to that, and then to get growth plus less risk is dividend growth. So those are the things that we're usually focusing on, and that gives you a lot of downside protection. And if you do well when the market goes down, over time, you're going to do well overall because the market's going up more than it is down. But if you do well on the downside, it's going to be a big bonanza for you. What we know is that over time, earnings double about every 10 years. And that's going back to the 1920s. It's consistently that. The thing is that when earnings
is that just across the board, small caps, large caps?
Well, that was the S&P. That study was done on the S&P 500 basically, and what we did was we once we did the low PE stocks, we said, how about dividends? And what it turned out that dividend yield on the S&P 500 was much smoother than earnings on the volatility over the 70-year period of time. So we blew those charts up each recession. And what it showed was in every single recession going back to the 1960s, the dividends, the thing is gone, by the way. Going back to the 1960s, every single period, every single year during every recession, the dividends increase by the S&P every single time. The only exception was TARP, the most recent, and that was artificial. And the bounce back in dividends after that was one of the biggest bounce backs ever. So what you have is, and what we found out in the dead decade, 2000 to 2010, you had the peak of the tech stocks, you had 9/11, and then you had the financial crisis. All that in a 10-year period. Probably one of the worst 10-year history periods we've had. And so if you look at that, actually the dividend strategy, value plus dividend strategy during that period was actually up almost double during a 10-year period of time. And the market was down about 7 or 8% per year down that same time period. So if you go back and look at it, well, why did that happen? Well, if you started off in the beginning of the year 2000 and you had 3% dividend yield on the portfolio, but dividend increases as you went through the whole 10-year period, kept inching up, inching up, and inching up. And so by 7 or 8 years later, you had about an 8-9% dividend yield on the portfolio at cost, which means the stocks aren't going to stay there. And they went up, and that's why the market went up. So dividends are very underrated. And so we've become more and more, that's going to become a bigger part of probably 80% of our business is in the high dividend strategy, high dividend plus value strategy. If you look at the history of value versus growth, the reason why value wins over that is because when the market's going up and it's a hot market, value will trail pretty consistently, but not by much. But when you get a tough market, value dramatically outperforms. And this year and the last year and a half has been a case. That's been a case of that. I'm doing a market letter right now, which is highlights that. And the market's changed. The market's changed, and you have a situation where you got all the earmarks for a stagflationary kind of environment. So you want to be taking less risk. So now it's probably more important to have dividends than normal.
There seems to be this sort of tortoise and hare thing between growth and value. So I saw a chart recently, for example, where, the Cathie Wood's ARK funds, they just had this incredible rise, and it's now come back down, and they overlaid it with Berkshire Hathaway, who's, just been chugging along. It's very not very volatile at all. And now, the performance of Berkshire is outperforming that of ARK. And so I think it's just a great archetype for what you're talking about there.
Yeah.
Given that a lot of younger investors, you yourself, coming out of the Navy and looking at these high flying stocks, it's so easy to get seduced and tempted by these high flying stocks. And they eventually turn into these acronyms, say FANG or, Nifty 50 back then, while the dividend yielding stocks might be slower to grow, with price appreciation,
right,
but may grow more reliably. So do you think the pendulum for dividends specifically is swinging back into favor for the next few years?
Oh yeah, for sure. As far as the millennials, which I was, right, the real smart thing I should have done is do your trading on one side, but set aside some money for investing, and make sure you know the distinction. And as far as investing, you don't try to market time, and you leave that alone. We have a chapter in the book on a bunch of doctors. I was at Donaldson, Lufkin, and Jenrette before I started the firm. And I had a bunch of doctors come in and that I was working with, and they had these IRA plans. They could put $25,000 a year in the IRA plans, usually 4 doctors in a group. And they put them away. These guys were making a lot of money in those days. And but they didn't touch those IRA plans. And except for the guys who got married a couple different times, and they were making all kinds of crazy investments, what have you. But the one doctor especially tried to preach to them to stick with that, not touch that money. And the ones who listened to him, who didn't get divorced, now those accounts are like $40 million. And they're up like 8,000% over the time period. And it was money that they just set aside, and there's no way they would have done that any other way. And we have an accountant down in Florida, and he said, "What happened to these? Where do these guys come from?" He says, "I never saw an IRA plan worth, $40 million." And it's because they stuck with the plan and held them. the temptation to change, and that's why I wrote the book. We said, the average investor, number one, they get no education in schools or what have you on the stock market. And Jason Zweig, actually, the New York Times, or Wall Street Journal, rather, who I know, and he wrote an article recently, and he said they are getting some education, but it's the wrong kind. They're having these contests where they say, who has the best performance for the month. And what they do, if you want to get the best performance for the month, you get the most leveraged stock, and and leverage it and do it on margin if you can, and that's going to win in an up market. And that's sort of the way a lot of pension funds run their money. Also, you get these 1, 3, 5 year presentations, and you look at them and say, "Geez, why is that?" I tell a story. I think it's in the book, but I think I tell a story. The first meeting I went to was a big foundation, and we're sitting there, and the Merrill Lynch broker was presenting 4 different mutual funds, and one was just dramatically better than all the others. So one of the people on the board there was saying, "Why the hell wouldn't we choose that one?" And they did. And it turns out that 2 years later it was a disaster, and it had been the most speculative stocks and leveraged, and therefore you got the best performance. And so the 1, 5 year, 1, 3, 5 year can really come back and haunt you. And but anyway, that's another story.
Well, speaking of 5 years, I mean, when you mentioned these younger people getting, again, tempted to compare their performance month over month,
right?
Really, they should be looking at a longer period, right, to smooth out volatility. So is that the 5 year? What do you typically go for?
Because what Graham said, he says, be a long-term investor and use a strategy. Well, but the average guy says, well, what's that long-term? And so we said that, or we came to the conclusion that using a 5 year time horizon gave you enough time to smooth the performance. And so we have in the book, we show all the 5 year periods going back to 68. And you had maybe 3 periods where you had a small amount of change over the time period. But then what happened the 5 year period after that was huge. And so the 5 year time horizon smoothed all the performance. And we have it later on in the book on the talking recessions and bear markets. How can you avoid those things? Well, in every single 5 year period, going back to 1968, you take all the 5 year periods, you get most of them double digit returns on the 5 year using a discipline. And every single 5 year period, you have some bear market, some recession, and you can try to drive yourself crazy trying to figure out when to get in and out of that. And but it smooths it out. And if you take the 10 year, it even smooths it more. I mean, 10 year, you say, why would anybody? I look at the pension accounts, and they have all these different alternatives they use in real estate, what have you. And I think using a dividend disciplined strategy would seem to be better than almost all those things. I mean, you get a double digit return in every single 10 year period. And that's in the book.
Hey everybody, Trey Lockerbie here from We Study Billionaires, and I wanted to tell you about a new company that I absolutely love, and that is called Trade. Trade combines 2 of my favorite things, coffee and technology. So what you do is you go to drinktrade.com, there's a super simple survey that you take, and then it tells you which coffee they're going to send you that you are literally guaranteed to love. Meaning, if you don't love it, they'll send you a new bag of coffee for free. And from there, you can keep experimenting so you're not falling into the same rut of drinking the same coffee over and over and over again. There are so many different types of roasters, levels of roast, beans from different parts of the world. There's plenty to nerd out on here. So why not be adventurous and try some new stuff? After I took the quiz, they sent me a bag from Sight Glass Coffee in Northern California, and it's literally my favorite coffee of all time. Normally, I've been drinking a coffee where I have to sweeten it with honey and almond milk, but this coffee, I could actually drink it black. It was so delicious just on its own. And right now, Trade is offering subscribers a total of $30 off your first order plus free shipping when you go to drinktrade.com/TIP or click the link in the description below. That's more than 40 cups of coffee for free. Get started by taking the quiz at drinktrade.com/TIP and let Trade find the perfect coffee for you. That's drinktrade.com/TIP for $30 off.
One of the quotes I loved in the book was from Peter Lynch, who said, "It's amazing to me how many people try to predict the stock market. If you spend 14 minutes on economics, you've wasted 12 minutes." I just thought that was really great. So how can we as investors avoid this? You spell it out a little bit in the book about avoiding these recessions. Is it just by buying and holding over the long term and not, basically turning our phones off and not looking at our screens anymore?
Yeah, I watch Bloomberg and CNBC every morning for an hour or so. And I'm looking at it. I can go and yell out the window here and say, "Oh no, don't do this." But it's sort of nice to know what's going on, and you're still looking for the best ideas you can get out of the framework. So, yeah, but it's as long as you're focused on not trying to trade that thing or take advantage. As long as you have some investment money on the side away from that, then yeah, that's a different story.
I want to talk a little bit about risk adjusted performance. So, how can retail investors focus more on risk and more specifically, actual risk adjusted returns?
Yeah, well, they have risk. I mean, you can use standard deviation or alpha, beta. You can use that as a guide or what have you. And I still say the best way to evaluate risk is to have a dividend discipline and be a long-term investor, and that takes care of it. And yeah, that's my solution to the best way to deal with risk. And if you look at these numbers on the book, you look at these numbers, you say everybody should be doing this. And but the temptation I also have in the back of the book it says, what happens when every year you sit down and you say, I'm going to make an investment, say, but the market's too high, or there's a recession coming on, or we're going to get stagflation. Let's wait a year. And I've been going back to 1920. Every year there's a reason not to get your money in that year. And so you sort of got the market over the same time period has a phenomenal return. So you just got to go with it. Actually, John Templeton did a study over a 20-year period of time. If you bought the market every year, if you're making a contribution every year over a 20-year period of time, and you bought the worst possible day every year, and the best possible day, the difference is only 1% over the 20 years. Amazing. So the compounding takes care of it.
So, are you a proponent then of dollar cost averaging, every
Sure.
paycheck, that kind of thing, going to your 401k?
Save it whenever you can do it. I mean, that's one message in the book. At the end, I have the 14-year-old paper boy, paper girl, compounded interest, and how that's the secret to investing, really, and how they start when they're 10 years old. When I put a small amount aside, the compounding. I mean, that's really the key for people to get started. That probably should have been the first chapter in the book.
Well, you've been running this fund for multiple funds, mutual funds, for a long time, and I'm kind of curious, if that's the case, and we're just kind of dollar cost averaging. There are cheap means to do that, with the Vanguard S&P 500, for example, which I saw on your website is a benchmark. I mean, most people look at that at least as some kind of benchmark. I'm curious what the mutual funds bring to the table, in your opinion, this day and age. How actively managed are they, and how do you go about getting alpha when you're primarily buying and holding for a long time?
I mean, some of the index funds can be okay. The tricky thing about some of the index funds, of course, is that the index funds compete with the market, and so they're going to stretch, their parameters to take a little bit more risk because they're trying to get performance. And so, especially we have a period in there where we talk about just the S&P 500 index fund. How it gets really overloaded with the top 5 stocks. And once the top 5 stocks with the highest PE multiples, once they become like 25% of the company, that's usually when it's getting way overpriced. And so therefore, after periods like that, then the index really dramatically underperforms. So you get wider swings in performance with the indexes. And people cheat on even value, the value indexes. If you look at the value, different S&P 1000 value index, what have you, you'll see they put names in there. You say, well, these aren't value names. But I think they're trying to make that index more attractive, or they say more representative.
Is the idea of the low PE performing over time just a reversion to the mean philosophy, if you will, just as a statistic approach? Is that because you got to hang your hat on something, over time? And is it just that you look back at the data and back tests and say, over a period of time, this does revert back? It might take years, but eventually it does.
Right. That's exactly it. That's a summary for it.
So You mentioned who you wrote the book for. I'm actually curious about that. It's written in this very approachable way. It's very bite sized, I would say, almost some of the sections. Was it for younger people, maybe even in your life, you wanted to pass along, or you mentioned there's a lack of education, you wanted to just get something in their hands that could help guide them over time?
Combination of two things. One, I think the thing that really started me is that value had been out of favor, so out of favor, like 10 years, which is unusual. And so it was a long period. And I remember going to a pension consultant who we used to do business with. And I said, when are you going to do a value search for a pension plan? He said, we haven't done a value search in 10 years. I said, oh my God. So not only was value forgotten, I mean, not only was it not being used, but basically been forgotten. And so I said, that's why I changed the name of the book, was going to be Long-Term Value Investing. I said, we got to make it a case for long-term value investing, because we got to start building the blocks from bottom up. And so it started there. And then what I know from being in the business for 50 years is that we're talking to clients all the time, and and most of them, you're trying to educate them as you go along, but it's hard conversationally to get through to people. And so I figured if you write this thing in a book, and then it's something that people can rely on a bit more. When people read something, then it becomes their idea, not you're telling them something. And I think it has more of an impact. And so then the secondary was really to educate investors, educate young people. And so it's a combination of the two things.
So then you're using the filters, if you will, so to speak, with the low PE, high dividend, low price to book. But once you've screened all of that,
right,
how do you pick the winners? What are the next steps from there?
Well, we have a chapter in the book on the research side, and use all the parameters, price to book, and payout ratios, and dividend yields, and all that, all the various ratios. Then you're looking for number one, you want to have diversification, because what you know is the strategy works. So you don't want to get locked into too many drug stocks, too many computer stocks. You want a diversified list of holdings. So we say traditionally we try not to do any more than 10 or 15% in any one industry, and be diversified. We know the strategy works. So we want to stick with so we participate in the strategy, and we don't get overwhelmed with any one group. So we start there, and then we get a portfolio which is dramatically cheaper than the market right now is, say, roughly 20 times earnings. Our portfolio is around 13, 14 times earnings. And we're always trying to get new names in the portfolio that are cheaper than what we already own. And it's an ongoing process. And in the book, we have where the ideas come from. They come from wacky places, all kinds of different places. I took one about a Canadian National. We owned International Nickel. And we were meeting with the analyst after he was visiting them, and he was updating us on International Nickel. And he said, at the end of the meeting, we're leaving. He said, oh, by the way, because that rail companies in Canada are going to be spinning off. They can't make any money in those things. What have you? They're going to spin them off. But we just made a lot of money in the U.S. because of revising and revitalizing the U.S. rails. So we heard that. We said, wow, I want to get involved in this. And so we started right at that point, and I went to a couple of meetings where there were pre-meetings where they're spinning these things out. And we made about 3,000% on our money on Canadian National and Canadian Pacific. And so that was, from you never know where the ideas are coming from. So we have research meetings. We used to have one every day in my office. And now we have 2 a week because of the COVID thing, what have you. We haven't got back every day, but now we have twice a week. But we're just constantly looking for where the ideas come from. And in the book, we have about 8 or 9 different places where, things come from.
Yeah, I love that part of the book, the by the way chapter. And it reminded me, we were just at the Berkshire Hathaway show, and Buffett talked about buying Allegheny. And to me, it spoke to this sort of idea of luck, where it's preparation meets opportunity, right? Someone mentions that to you, but you had clarity on the opportunity. You were able to identify it and take advantage of it. Whereas, with Allegheny, it basically happened in a similar way, where the new CEO, used to work, was an old colleague of Buffett. And so basically called him up to catch up. And then he
Yeah.
That's when the idea came to him after 40 years of like studying the
Right.
stock. It was finally
Right.
like, hey, maybe now's a good time. So yeah, these ideas can really come from anywhere. So when I'm looking at the funds, one thing you brought up a minute ago was diversification. And a lot of times with these funds, there's only 30 to 45 stocks. So that's
Right.
that's really you have to be really rigid to make it fit into the portfolio. So what are some of the other qualifiers for, say, you found this rail company versus another rail company? They've got similar metrics. Does it come down to management, or what are some of the other
That's
factors
a
that?
big deal. One thing we sort of missed here, and I have a book in the book I mentioned management and the importance of management. Jamie Dimon, for instance, and one thing about and Iger of Disney. The one thing I didn't mention, and actually, when you think about it, equally important when a good manager leaves a company. I mean, you want a good manager. We in the book we mentioned 3 or 4 managers that were the reason why we bought the stock. And but actually, when somebody leaves, usually more often than not, it's probably a good idea to reevaluate the company because there's an adjustment that goes on. So management is always a big part of it. We have in there called a 3-point fix. So you get stocks which are 3-point fix is a Navy term. It's you go in the harbor, you get 1-point fix. As the harbor's fogged in, you're probably going to be okay. You're going to get in your slip. You get 2 points, you get another fix, and that gives you a better chance. If you get a third fix, you're going to get in the harbor, no matter how fogged it is. And so that's why. So in investing, you have characteristics, long stocks, cheap, makes sense, what have you. And then you think you have. You never know whether you have a story or not, but you think you have a good story on something. Then, if you can catch something which periodically will go out of favor, and time that. And that's the third point in the fix, skipping something that's been out of favor. We went back and looked at the stocks that were the stocks we made over 1,000% in, say, over time. It's usually when, for some reason, you get a stock that makes a lot of sense, and we think we have a story, but for something happens and the stock gets sold off and becomes really cheap on a valuation basis, on a price basis. And so we're constantly looking for that also. And like one we use, I think one of the examples we used was Merck when they had Vioxx. And I mean, Merck was always selling at 20 times earnings. It came down because of the competition in the industry. And then all of a sudden it gets down to like 10 times earnings because of Vioxx. Yeah, was giving lawsuits, what have you. And if you bought then, the next thing it was, up 1,000% over the next 5 years. Yeah. But
It
so anyway,
seems like,
that's always a guessing game to a certain extent. That's inexact science. The the picking the stocks.
is that what gets you out of bed in the morning? I'm curious because, with this systematic strategy, there is that art piece to the science, as you kind of mentioned. So is that I'm just kind of curious. You've been doing this a long time and a lot of this is buy and hold. What keeps getting you out of bed to go do this every day?
Well, that's why I watch the CNBC and what have you in the morning. And I get Value Line. Buffett does this also. I get Value Line every week. And that gives you a lot of coverage of all the stocks. And that gives you all the financial data on them and who has how much debt, what have you. So you're looking for companies with less debt usually. But a combination of all the things you put together, and you're hoping something jumps out at you, and that makes it fun. There's a guy who does a report, 13D Research, and he does very thematic strategies. And we've got a couple good ideas out of him. And there's certain people you rely on that have been very helpful.
Very cool. So I'm kind of curious, going back to the younger investors who I think this book will really speak to, who are so driven to growth. There's a lot of data in this book that you lay out. What should these younger investors know about growth-oriented stocks based on the data in the book?
Well, just the history that you got to be careful because all of a sudden, if you get caught, the history, these things, and all this, and every single cycle, the companies that peaked out had great earnings for the next usually 5 or 10 years. The earnings continued fine. It was just prices got too high. So that's the danger. Amazon, for instance, here. I mean, Amazon, I mean, starting getting competition in their industries. Companies get so big that they start competing with each other, and then all of a sudden, instead of buying little minnows, they wind up, dealing with sharks. And so, how much of an impact that has on a company? But eventually, they could have. Usually, the business continues to be halfway decent, just the growth rate slows because it's got more competition. And then all of a sudden you wind up, in every single case we wound up there, you wind up getting these stocks down to where their value levels, and they can be bought for a value guy. Whether this happens here or not, I mean, you look at, it seems like early in the game, but Alphabet looks like it's only 20 times earnings, so it looks pretty inexpensive. So I know our guys are doing some work on what stocks are early. The young guys we have, all of a sudden, they want to get more of these more interesting stocks early if they can find them.
Do you ever find periods where you can have your cake and eat it too, meaning you find a high paying dividend stock that's undervalued, and because there's that cyclical rotation, you're getting that price appreciation along with the high dividend payment?
Well, that's what you're looking for. And what you want is dividend growth. I mentioned dividend growth. So these are companies, I mean, we don't look for just dividends. We started the strategy in 91. The only thing they had, equity income was a category. And equity income was a high yielding stocks, most of them utility stocks, but dividend growth wasn't a factor. And we said, okay, you know what? You can have a broader, diversified list, but look for dividend growth. And that's a key part of the strategy. And so we're looking for companies that can grow that dividend. And our average growth has been about 10% a year over the last 5 years. And, that's what we're looking for.
Kind of curious to hear on that point, then, your feeling towards share buybacks. Berkshire, for example, I think they issued a dividend once and never again. So what's your opinion on finding stocks that are doing lots of share buybacks if it's seemingly at a good price?
Seemingly at a good price. I mean, most of these companies that I've seen buying their shares back are buying it back at ridiculous P multiples. And I think having a dividend discipline gives companies a little bit more of a discipline themselves, because it's not like, just buying shares and you may do it or you may not do it, postpone it or may not postpone it. Once you establish a dividend policy, they want to stick with it. Unlike global, the Europeans, if the earnings are going to go down 30%, they'll cut the dividend by 30%. But in the U.S., as I mentioned earlier, the S&P 500, they've increased dividends every single year through all the recessions. Back in 1975, when I mentioned that period with Wall Street, when Boston, you had a dividend increase every single period during that whole time period, and it's phenomenal when you look at it. Meanwhile, you knew earnings were down 50%, stocks are down 50%, they're still increasing the dividends. So you want to make sure you have companies that have, a low payout ratio. You don't want to buy somebody who's paying out 90% of their earnings in dividend. You want somebody who has a lower payout ratio and where they can grow the company. And that's the question. And it's a trade-off. The more you can get in dividend growth, the more companies. I think it used to be dividends weren't as important for companies. I think a lot of people started to realize that dividend yield is more important as far as stock price now. But you still have a huge focus on buybacks, which I don't get.
Yeah, it's always kind of seemingly controversial, the buyback thing right now. And if done correctly, it can be a great thing. But I like your take on dividends and that focus. So you've been running this firm for a very long time now, and I'm curious. I'm going to get to a couple of points here in a minute, but one I guess is, has there been a time in your career where you felt like things were hitting on all cylinders, you were in the sweet spot of your strategy, and it was playing out well? And what environment did that look like, and what year was it? When was that kind of time, if you could reflect back?
This is probably back in after the market peaked, in 2000, and rolled over. And we started a mutual fund at that point, 2001, 2002. And actually we did a sub-advisory with Pioneer, which was the British and the Italian advisory firm. And we did a sub-advisory with them. And that was the right time. And we were like in the top one percentile, the 1 year, 5 year, 3 year, was posted in the Wall Street Journal once a month, and we were there consistently in the top of that. So that everything was going right, and we raised about $7 billion in about 3 years, 4 years, and so everything was clicking in there, and then all of a sudden you get to a period where you value's out of favor and you have to struggle.
Yeah, exactly. And certain folks seem to acknowledge the macro. I mean, I imagine when you're looking at when you're watching CNBC in the morning, it's hard to avoid. They're always bringing up macro stuff. So it's that importance of awareness, but not necessarily letting it influence your strategy. Right. And that seems like so easy to just say, but so hard to actually play out in practice. So do you have any things in place for you so that you're not touching the dials when, maybe you shouldn't be?
Yeah, I go back and look at the chapter we have in there on recessions and bear markets. And you look at that and you say, the temptation here to try to get this right is almost overwhelming. But then you go back and look and say, okay, let's superimpose the rolling 5-year periods over that with those recessions all plopped in. And so instead of seeing all this jagged down, up, what have you, you get this smoothed out picture with all these recessions in each one of those 5-year periods. And that's your religion, I guess. That keeps you in the game. But it's hard. I mean, we have doctors who did kept with the program, but it's pretty hard to keep people in over a long period of time. 2000 and 99, the year before 2000, we had people calling up and the growth was up, value was down. It's one of those pivotal years. And usually a pivotal year like that, usually at the beginning of a term, which it was then. But we were getting fired, guys. And I'd said to people, only sell half. Dude, you're getting fired 10 times, 20 times a day.
Yeah, that can't be easy. I mean, those phone calls, you get used to it over time, or, how do you manage that?
Yeah. And
you have people who have been with you a long time, probably who trust in it. And
right.
You build that trust over time.
A lot of belief. If we can get people through a 5-year time horizon, then a lot of them become believers. And so that's why we have some business up.
So with your approach, at the dividend approach, is something that people miss very often is comparing price appreciation to the benchmark, say the S&P 500, rather than the total return based on the price appreciation, but also all the dividend payments that have come in?
We always compare the total return versus hard return, and as a guide, we're trying to beat that bogey all the time. So we don't look at it without the dividends. We just look at it, total return on both.
So one thing I found interesting in the book was the part on covered calls. So, when is it, I mean, options have become, they're always kind of around and trendy, but in the last couple of years, they really exploded. In popularity. Right. I think covered calls are a great means to kind of generate some dividend-like income on an asset you're owning over time if you don't want to sell it. But talk to us about when it's appropriate or when we might not want to incorporate something like a covered call.
Well, we always had the high dividend strategy, and at this stage, this is back in we started in 2010, and we had a couple of accounts, that institutional accounts, where periodically we would write on the most expensive stock, so we wanted to sell. Well, we're looking for a new name. If something that's so getting overpriced, let's sell the option, write the option, and hopefully we'll lose it. And both meanwhile we're getting paid while we lose it. And so we started that with a couple of clients. And then all of a sudden the bond market comes down, interest rates come down, broke through 2%. So you're getting down to 1%. And I'm saying, why wouldn't every single bond guy want to take a sliver of his portfolio and invest in a strategy like this? Because what you get is the high dividend strategy, which had about a 5%, 4.5%, 5% dividend yield. If you do the options writing on top of that, we had another 4% there. So the average yield, the average return for the average yield was about 7%, 7-8%. And the risk level was even better than our high dividend strategy by about 10%. And so we started for that reason. I mean, so this would be ideal especially because you get commissions on the trading for tax exempt accounts. And so we started it. And I said, this again would be ideal for pension accounts. And I'm a lousy salesman, so we didn't do that great on the pension accounts. But we have about $1 billion in the strategy now, finally. But there's been more of an interest in what we see this year. It's outperforming our high dividend strategy by 2 or 3%, and in the down market. So I think when we were down 4%, that was flat, and the market was down, 10%. So it's an interesting area, and developed out of the watch the market. What can you do? I mean, you mentioned small cap, and we've always had a little bit of small cap stocks, maybe in a portfolio, the value portfolio. We also had periodically some international names if they were cheaper. And what you see on small caps is anytime you have a really down year in the market, the next year for small caps is phenomenal. And therefore, because of that, if you look at that small cap over the last 60 years, small cap performance is pretty good, only because you have such a recovery after a bad year. And but small cap is probably lining up today, probably pretty good. There's a big difference between small cap value and small cap growth, of course. And the same with international. Our international portfolios actually have a higher dividend yield. You just have to be more careful of those. We have a little more diversification because you have more risk. And but the dividend yield is like 5.5%. It's a lot higher. P multiples less, and we make sure the debt's less also. And so they're all outgrowths of the original strategy.
So as we're kind of winding down here, I'm kind of curious. I like to say that I came to investing for the money, but stayed for the philosophy. I find that I find all these like kind of nice frameworks for living life and, being patient. And, I'm kind of curious for you, have you found anything while we're even writing this book, perhaps, that you can actually apply to your life and how to live a good life?
The book was work. I mean, I write market letters about three or four a year, going back to when I was at Donaldson, Lufkin, Jeter. So it's about 35, 40 years of writing market letters, which I'm comfortable with. Writing the book was a challenge. And so that was work. But I love to read, so that's sort of. But anyway, so it was satisfaction to getting it done. But otherwise, not directly. I find reading is a good hobby, reading and tennis. But you can go sit on the beach, and sometimes with the markets the way they are, I like to go sit on the beach with a good book and hide out.
That's a really good strategy. I'm going to take that one. Well, Jim, this has been just such a wonderful conversation. I'm so excited to have you on the show, and you've written this amazing book, and your market letters are incredible. Everyone should check them out. Before I let you go, tell the people listening where they can find the book, where they can find more about you and your funds and those market letters exactly.
Okay, I guess the Amazon is where the books are. Our publisher is in London, and but basically we're located in New York City, Olympic Tower, 645 Fifth Avenue. We've been there for 40 years, same building. And so if anybody wants to contact us there, want any information on our market letters or what have you, that's probably the best place to get us. And we're about 100 of us there. We got a floor there on 51st and 5th. If New York ever really opens up again, so gradually, I'm here in the hotel up on the Upper East Side. Place is booming up here, and you go down to the offices, people just aren't coming in yet. Even our place, the research guys are coming in, and we're never more than half full. But everybody's enjoying the openness, because all of a sudden you have all these restaurants outside, which you never had before in New York. So that part is a lot better. And so anyway, it's.
Well, Jim, this has been so great. And the book is called The Case for Long-Term Value Investing, a guide to the data and strategies that drive stock market success. Thank you so much for coming on the show and spending your valuable time with us, and just in general teaching, using this book, using your letters, and sharing the knowledge you've accrued over such a great and amazing career. So again, we really appreciate the time, and I hope to do it again soon.
Thank you very much. And if you get to New York, stop by to see us.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.